Hello options traders, welcome back everybody. And today we're going to hit our fourth and final Greek for this week, Vega. Well, by now I think everybody knows where these Greeks are coming from. They are outputs from a pricing model. So here's the example I've been showing here throughout these classes, and look right down here is Vega. So remember that all of your Greeks are simply mathematical measurements about an option's sensitivity to something else, to some factor. But the important point is, how do we interpret it? And even more importantly, how do we use that strategically in our option strategies? So let's take a little deeper look at Vega. Vega simply measures the change in the option's price for what's called a 1 percentage point, or sometimes we call it a 1 tick change in volatility. So what does that mean? Well, for example, let's say that volatility is currently 20% and it moves to 21%. That's a 1 percentage point change, or a 1 tick change. We are simply adding 1 to it. Of course, if volatility fell 1 tick, it would be going from 20 to 19 and so forth. Sometimes you'll hear new traders get this confused and they'll say, well, if volatility is 20% and it moves 1%, it should therefore be 20.2%. And that's not correct. We are not talking about moving volatility 1%. We're moving it 1 percentage point, which just means you're adding the number 1 to that figure. The important point to understand is that all option prices increase, calls and puts, as volatility rises. And therefore, when volatility falls, all of your option prices will drop. Well, what's the big question we have? We'd like to know by how much. Is my $10 option going to go to 15? Or is it going to go to $10.01? Knowing that it's going to rise is a little helpful, but not much. We really want to know by how much, and Vega shows the answer. Now, interestingly, Vega is not a Greek letter. The Greeks don't actually have a letter for V, so they kind of just made this one up to sound like a Greek letter. But just remember that V, Vega, is for volatility. So here's an example. Let's say we have a $50 call trading for $1.15, and the platform shows that it's currently priced at 20% volatility. And most brokerage platforms will show you this. I'll show you some examples at the end of the video. But we also look and we see that this option has a Vega of 0.05. And what that means is that if volatility increases by 1 tick, in other words, begins trading at 21% right now, that's another important concept. All of your Greeks are a right now type of a concept, not in a week or in a month. We're talking about an instantaneous change in volatility to 21%. What's going to happen to my options price? It's going to move from its current price of $1.15 to $1.20. And I find that by simply taking the current options price of $1.15 and adding Vega to it. So Vega, like most of your other Greeks, is measured in dollars. What's the exception? Hopefully you said gamma. Gamma is showing us a sensitivity of delta. But all of your other Greeks are an option price sensitivity. They are measured in dollars. So you can think of that as 5 cents. It's going to either add or subtract 5 cents to my current options price. Now, of course, if volatility were to immediately jump to 21%, I will get a new options price of about $1.20, but I'm then going to get new Greeks. I'll get a new delta, gamma, theta, and Vega. So this Vega is only good for the next 1 tick change in volatility. Well, obviously, if volatility falls from 21% to 20%, then we would subtract off Vega, and I would expect my option would be trading for about $1.10. Vega is the greatest, in other words, it's maximized for at-the-money options. So for any given expiration, if you find your at-the-money option, again, that's the one whose strike is trading very close to the current stock price, it will have the largest Vega. That's actually true for all of your Greeks. They are all maximized at the money with the exception of delta. Remember, delta is going to be about a half for an at-the-money option. Delta becomes maximized once the option moves very deep in the money. Stock price goes well above that strike for calls or well below it for puts. But all of your other Greeks, not counting delta, will have their largest values at the money. Let's take a look at Vega graphically. We took a look at a profit and loss diagram like this in the theta class. And again, for people who are not familiar with these profit and loss diagrams, there is a separate video in here called Profit and Loss Diagrams. But the yellow curve shows us the expiration graph for, in this case, a $50 call purchased for $4. That's what our profits or losses will look like at expiration. However, today we need a different curve, and we need to generate that with a theoretical pricing model, and we might get this one here in green. And we might be using, let's say, 20% volatility to generate that curve. And so what it's telling me is that what is the option price going to be at various stock prices? So again, for example, let's say the stock price hits 55 today. What's my option going to be worth? Find 55, trace a line up to that green line, and look left. It's going to be worth about $3. So that's the way we read off of this green line. However, what's it going to do if we increase volatility to 21%? That green line is going to get shifted upwards. So this is a little opposite from what we normally see from our profit and loss diagram. Most of the time we're used to seeing that curve move towards the yellow line as time goes by. But if we increase volatility, or if we buy a longer dated option, we increase time, you will shift that curve outwards. And so notice that this little gap in here, this outward shift, is what Vega is measuring. By how much did that option's price change when we increased volatility? Another aspect of Vega is to understand that it is always positive for long options. Doesn't matter if it's a call or a put. If you buy it, you have positive Vega. And that just means that those options are going to increase in value if volatility rises. They will also decrease in value if volatility falls. But the important point is that it doesn't matter if it's calls or puts. If you buy it, you've got positive Vega. So why do we get positive Vega? Because time and volatility are two different ways to potentially increase an option's value. And Vega measures volatility. So if you think about it, if you have an option, there are two ways that you could potentially give that stock more ability to move to higher levels or to lower levels for a put. You could either give it more time, or you could keep the time the same and increase the volatility. So time and volatility have a positive effect on option prices, assuming they are increased. When they are decreased as time passes or as volatility falls, the option's prices will fall. Now, sometimes this is a difficult concept for new traders to understand, so let me show you why volatility positively impacts option prices. What I've done here is I've created a little stock market simulation in Excel. I'm not going to really explain how I did it, but basically I've created a hypothetical $100 stock, and it's going to trade for 250 trading days, which is roughly the number of trading days in a year. And I'm going to give it 20% volatility. And what this means is I'm not going to allow for any hypothetical news. I'm not allowing for anything other than the little day-to-day zigs and zags of the stock market to move this stock along for a year. So let's turn our first stock loose for the course of a year, and this is one possible path. Now, just like if we flipped a coin 250 times, we would get a particular sequence. We shouldn't expect to get the exact same sequence if we did it again. And that's what's going to happen here. So if I create another $100 stock and give it 20% volatility, and I turn it loose, this might be the path that we end up getting. I do it again. Little different path. And again. And again. Most of these are all kind of starting and stopping in the same area, but if we keep doing it, we notice that we get more and more variation. But there also seems to be an invisible ceiling and floor. Those are things we'll talk about more with volatility, but the important point to see here is that if we were to measure all of the various ending stock prices down there in very small ranges, so like every time it hit between $100 and 100.10, and between 100.10 and 100.20, and we looked at all these small ranges, and we tallied up how many times these stocks landed in those little buckets, we would end up with a bell curve. Whenever you have volatility, the width of that bell curve will change or increase as you increase volatility. So for example, if I increase it from 20% to 40%, watch what happens to the spread in these stock prices. Yeah, you can see much more erratic, much wider variations. And so we would still get a bell curve, but it would be much wider, saying that there's a much bigger potential range of prices for this particular stock. So let's compare 10%, 20%, and 40%. You can see the 10% one is very focused, like a flashlight beam. But as we start increasing the volatility, those potential prices start to spread out. Notice the bell curves on top, very tall and skinny, what we would call a very small standard deviation, or in stock market trading terms, a very low volatility. The 20% graph, we start to see a little shorter curve, but we start to get a little wider variation, a wider standard deviation because of the higher volatility. And then finally at 40%, look how short and wide that curve is. It's showing there's a lot of potential prices that could occur over the year. So the thing that throws people is they don't understand why high volatility gives us high option prices. Well, let's take a look at the reverse. What if we have low risk or low volatility? It's going to give us low option prices. Why? Here's an exaggerated example. Let's say we have a stock currently trading at 50, but the very highest it could go is 51, and the very lowest it could move to is 49. So the bell curve for this stock is going to be very tall and skinny. There's no volatility. Well, what are the potential option prices at expiration? If the stock hits 49, it's worth 0. Stock's at 50, the option's worth 0. And if it gets to 51, it's worth $1. Yeah, there'll be some little pennies in there if it closes somewhere between 50 and 51. But overall, this option just doesn't have the ability to be worth much money. How much would you pay for such an option? Not much. And the reason you wouldn't pay much is because there's no volatility. There's no chance for this option to get pushed very deep in the money. Conversely, if we have high risk or high volatility, we end up with a high option price. So let's take that same stock trading right at 50, right at the center of that bell curve, but we're going to pump up the volatility. That curve's going to get very flat and wide. And now the stock might fall down to 46, it might rise all the way up to 54. What's it going to do for our potential option prices now? Well, now the stock can hit 51, 52, 53, 54, and that means my options price might be as high as $4 at expiration. So, yeah, would you rather have an option that might have the ability to reach a maximum of 1 or a maximum of 4? Obviously, the higher the potential maximum, the more you're willing to pay for the option. Now, there's one other little wrinkle here that throws people, and they say, well, that sort of sounds like it makes sense, but aren't you going to be faced with bigger losses too under higher volatility? And the answer is no. This brings up another interesting characteristic of options. Options have what is called an asymmetrical payoff. So take a look at the numbers down here. Notice that if the stock closes at 50 or below, we end up with a worthless option. We don't continue to lose dollar for dollar as if we owned shares of stock. We have positive gains we can make over here in green, but we don't have negative losses, at least in the sense that they are continuing to grow. If the stock price falls, we just flatten out. But if we own the shares instead, what would our left side of the graph look like? Yeah, we would have -1, -2, -3, and -4 as that stock price falls. So stock has a symmetrical payoff structure. And yes, higher volatility for a stock means higher rewards, but it also means higher losses. For options, higher volatility means higher rewards, but we don't get correspondingly higher losses. And because of that beneficial property, higher volatility is going to boost option prices. There's another final aspect I'd like to talk about here since we're talking about volatility, and that is the risk of selling out of the money options. And you hear this stuff a lot from new traders, and they'll say, oh, I sell these very far out of the money calls and these very far out of the money puts that have virtually no chance of getting hit, but because they're not worth a lot, I'm going to sell them 100 times, and I seem to get a free $2,000 every single month into my account. Well, there's a problem with that. And while it's true that at-the-money options have the highest Vega in dollar terms, out-of-the-money options are the most sensitive to volatility in percentage terms. And if you think about it, what probably means the most to you is what happens to your account in percentage terms. So there's another little trick. Actually, we can do this with all of our Greeks, but there's a trick that we can do to do what's called normalizing it. And we can look at a normalized Vega, where I'm going to take the current Vega divided by the option's price. And that's going to tell me how much that option's price will move in percentage terms if volatility makes a one-tick move. So here's where the dangers can occur. Let's take a look at this top pricing model up here. I got a $50 stock, $50 strike, 30 days to expiration, 20% volatility, and 2% interest rates. And it tells me that the call should be worth about $1.18. Now, down below, I've kept all the factors the same, except I've increased volatility from 20% to 40%. And all things being equal, if you double volatility, you should roughly double the option's price. And look what happened. We went from $1.18 to $2.32. We roughly doubled the option's price. Now let's take a look at how out-of-the-money options are affected by volatility. Up top here, I have the stock at 50, but now I'm looking at the 55 strike. So it's a $5 out-of-the-money call. I'm using 30 days to expiration, 20% volatility. And it tells us the call should be worth about 6.5 cents. So once again, these are the types of options that a lot of these traders who love to sell out-of-the-money options will turn to. And they'll say, yeah, I'm not getting a lot of money, maybe 6, 10, 15 cents, so I sell them 100 times. And I'm selling calls and puts so I can double up on it. And the chances for these to get hit is virtually zero, so it's like free money every single week or every single month. And what they're not realizing is they have a huge risk with Vega in percentage terms. So look down below. All the factors are the same, but I'm just going to increase volatility from 20% to 40% like I did last time. But notice it didn't double my options price from 6.5 to 13. It went to 70 cents. Now, it still doesn't sound like a lot of money, but that's 11 times bigger. So if these people are selling 100 contracts or more to try and collect some money, and this position moves against them because volatility spiked by a factor of 11, that's going to be blowing up your account. And the real problem is it doesn't matter what you think. If you think, well, it's going to blow over and I'll work my way out of it, if you go into a heavy maintenance call, which is what's going to happen when you're selling naked calls and puts, the broker's going to close that position whether you want to or not. Now, what's also going to happen if you have naked puts out there that go up 10 or 12-fold? Why do you think volatility spiked? Probably because there's some really bad news. So not only did you get hit with the volatility spike, but if that stock happens to take a 5 or 10% move downwards, even if it's not approaching your strike price, but we just lower that stock price a little bit, these options now are going to be worth $2 and $3, $4. And that could literally blow up an account instantly. And like I said, it doesn't matter if you're confident that the storm's going to blow over, the broker's going to close that position at the bottom. So I hear this a lot, especially from new traders when they learn about selling naked options. And they say, I can sell these way, way, way out of the money calls and puts, has almost no chance of becoming in the money. And they fall under this impression that it's just like getting free money. And the problem is it might work for several weeks or several months. It might even work for much longer. But it only takes one time before that entire account is done. And it's normally because of Vega. All right, let's take a look at a live platform and see Vega in action. Here's Apple trading for almost 188. So we'll look at the 190 strikes, which would be our at the monies. And right down here, we see the options trading for 285. And look over here, column of Vegas. And it's showing 0.21. Notice that it is the highest value in the entire column. That will be true because it's at the money. All of your Greeks are maximized at the money with the exception of delta. To the right of that, we have implied volatility, about 17.5%. So what is this Vega telling us? What it means is that if the implied volatility moves to, let's call it 18.5% right now, I'm going to tack on 21 cents onto my option. So we look over here, it's trading for $2.83, and I would expect that option to move to about $3.04. If instead volatility fell to 16.5, fell one tick, I would expect my option to lose about 21 cents and be trading for about $2.61. So once again, Vega is just telling us how sensitive our options price is to changes in volatility. Let's look at some of the other characteristics. First of all, the Vega was positive for the 190 call. Over here for the put is also the same. It's positive. Call and put Vegas are positive, and that's because all option prices increase if volatility rises and they all decrease if volatility falls. If you buy an option, you've got positive Vega. If you sell an option, you've got negative Vega. Now, what else did I say throughout the presentation? Longer dated options have a higher Vega. So let's come back over here to the calls, and we see that the Vega for the 190 strike is 0.21. What do you suppose would happen if I go out to October? I'm going to change this now to October, and we see that the Vega has now gone to 0.48. It increased because we went out in time. What would happen if I came closer in time? It should decrease. So let's move from June, which has about 29 days. We'll come down here to May 25th. It has 8 days. And the 190 call has a Vega of 0.10, almost 0.11. And the rationale for that is, again, with so little time remaining, there's just not a lot of potential for that option to gain intrinsic value. We would either love to extend time or extend volatility, and both of those will increase Vega. So I hope this helps you to understand the basics of Vega and all of the other Greeks as we wrap up Greek Week here, and we'll be doing some more videos with some wrap-ups and showing you how to apply them for some strategies. But the main thing to understand is that these Greeks are not there just for decoration. Yes, they might seem a little complicated, but they are tools. They are powerful tools. And depending on what you're trying to do, my guess is that almost nobody is using them to their fullest benefits. You need to understand how to combine these to get the most out of your strategies. And even more than that, how can you hedge, roll, morph, and use all of these other tactics that we have for option strategies to further enhance these Greeks? But to do that, you've got to take one step at a time, and that means to understand your Greeks. So I hope that helps you understand Vega. And if you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com, or please instant message me here in Facebook.